The company that rules the world, BlackRock, power, and the architecture of global finance. There is a name that appears again and again in discussions about global finance, corporate ownership, and economic power. A company so large that it manages more money than the GDP of most nations. A firm that holds shares in thousands of corporations across nearly every industry on Earth. To some, it represents the hidden architecture of modern capitalism. To others, it has become the centerpiece of sweeping claims that a single institution quietly rules the world. That company is BlackRock. To understand the reality behind the myth, we first need to understand what BlackRock actually is. Founded in 1988 in New York, BlackRock began as a risk management and fixed income institutional asset manager. Its founders, led by Larry Fink, focused on one core idea: managing risk carefully in bond portfolios. Over time, the firm expanded beyond bonds into equities, multi-asset strategies, real estate, alternatives, and eventually exchange-traded funds. The acquisition of Barclays Global Investors in 2009, including its iShares ETF business, transformed BlackRock into the largest asset manager in the world. Today, BlackRock manages trillions of dollars in assets on behalf of clients. That number alone is often enough to trigger suspicion. Trillions is a word so large it almost feels abstract. But it is essential to clarify what managing means. BlackRock does not own this money in the way an individual owns a personal bank account. Instead, it manages funds for clients such as pension funds, insurance companies, sovereign wealth funds, universities, charitable foundations, and individual investors. When someone contributes to a retirement account invested in an index fund, that money may be managed by BlackRock. The assets belong to the clients. BlackRock acts as a fiduciary, making investment decisions within defined mandates. Because BlackRock offers index funds and ETFs that track entire markets, it often becomes one of the largest shareholders in many publicly traded companies. If a fund tracks the S&P 500, it must hold shares in all 500 companies in that index. The larger the fund, the larger the shareholdings. This structural reality explains why BlackRock appears on shareholder lists of major technology firms, banks, pharmaceutical companies, energy producers, and manufacturers. It is not necessarily choosing to control those companies. It is replicating market indexes that investors choose to buy. However, ownership stakes, even minority ones, can create influence. When a firm consistently ranks among the top 3 shareholders in thousands of corporations, executives pay attention to its views. BlackRock engages in corporate governance through proxy voting and direct dialogue with company leadership. It publishes stewardship guidelines and outlines expectations on issues such as board independence, executive compensation, risk disclosure, and long-term strategy. Critics argue that this gives BlackRock disproportionate sway over corporate behavior. Supporters counter that large asset managers are obligated to monitor and engage with companies to protect client interests. The perception that BlackRock rules the world often stems from a misunderstanding of how modern capital markets are structured. In the past, ownership was more concentrated in families or individual magnates. Today, ownership is widely dispersed among millions of investors through pooled investment vehicles. Asset managers like BlackRock act as intermediaries, aggregating the savings of individuals and institutions. This aggregation creates the appearance of concentrated power, even though the underlying capital belongs to a broad base of investors. Another factor that fuels speculation is BlackRock's role during financial crises. During the 2008 global financial meltdown, governments and central banks sought expertise to manage distressed assets and stabilize markets. BlackRock was hired to advise on certain programs because of its risk management capabilities and its proprietary technology platform known as Aladdin. Aladdin integrates portfolio management, trading, and risk analytics and is used by many financial institutions around the world. The fact that governments consult private firms during emergencies can raise concerns about conflicts of interest. Yet it also reflects the complexity of modern financial systems and the reliance on specialized expertise. In the years since the crisis, BlackRock's CEO Larry Fink has gained attention for his annual letters to corporate leaders. These letters often emphasize long-term value creation, sustainability, climate risk, and stakeholder considerations. BlackRock has been associated with ESG investing, environmental, social, and governance principles, which aim to integrate non-financial risks into investment decisions. For some observers, this demonstrates responsible leadership in confronting global challenges such as climate change. For others, it represents corporate overreach into political or social domains. The debate over ESG illustrates how financial influence can intersect with broader societal issues. Despite the scale of its operations, BlackRock does not possess sovereign authority. It cannot enact legislation, deploy military force, issue currency, or impose taxes. Those powers reside with governments and central banks. The Federal Reserve sets monetary policy in the United States. The European Central Bank governs monetary policy in the Eurozone. National legislatures pass laws. Regulatory agencies oversee financial markets. BlackRock operates within these frameworks. It must comply with regulations, disclose holdings, and answer to shareholders and clients. Yet, it would be inaccurate to dismiss concerns about concentration entirely. The asset management industry has consolidated over decades, with a handful of firms managing a substantial share of global investable assets. This concentration raises important policy questions. Does common ownership by large asset managers affect competition between companies? Could systemic risk arise if a major asset manager faced severe operational disruption? Are there sufficient safeguards to prevent conflicts between advisory roles and investment activities? These are legitimate areas of academic and regulatory inquiry. The narrative of a single company secretly orchestrating world events simplifies a far more complex reality. Modern economic power is distributed across networks of institutions. Multinational corporations, investment funds, banks, central banks, regulators, governments, and international organizations. Influence flows through capital markets, policy decisions, trade relationships, and technological innovation. BlackRock is a significant node in this network, but it is not the network itself. It is also important to recognize the role of passive investing in shaping BlackRock's prominence. Over the past 2 decades, investors have increasingly shifted from actively managed funds to passive index funds because of lower fees and consistent long-term performance. This shift has directed enormous inflows into firms that specialize in index strategies. BlackRock, along with a few other major asset managers, benefited from this structural trend. The growth reflects investor preferences rather than a coordinated attempt to centralize power. When critics point to charts showing overlapping ownership among major corporations, the implication is often that coordinated control must exist. In reality, index funds hold shares in proportion to market capitalization. If a company grows large enough to dominate an index funds must hold it. This mechanical process can produce extensive cross-ownership patterns without deliberate coordination. Still, the visibility of these patterns can create an impression of omnipresence. The broader question raised by discussions about BlackRock is not whether one firm rules the world, but how power operates in financialized economies. Capital allocation shapes which industries expand and which decline. Access to financing determines whether infrastructure projects proceed or stall. Investor expectations influence corporate strategy. Asset managers, as stewards of vast pools of capital, participate in these processes. Their decisions ripple outward, affecting employees, communities, and markets. Accountability in such a system becomes crucial. BlackRock's influence, like that of any large financial institution, is subject to oversight by regulators and scrutiny by the public. Transparency reports, stewardship disclosures, and regulatory filings provide insight into its activities. At the same time, critics argue for stronger antitrust enforcement or reforms to corporate governance rules to address concentration. These debates are part of the ongoing evolution of capitalism. It is tempting to search for a single entity to blame for inequality, economic instability, or globalization's disruptions. Complex systems, however, rarely hinge on one actor alone. BlackRock operates within incentives created by clients seeking returns, companies seeking capital, and policymakers seeking growth and stability. The firm responds to market demand, regulatory constraints, and competitive pressures. Its scale amplifies its voice, but it does not grant unchecked authority over global affairs. Understanding BlackRock requires moving beyond dramatic narratives and examining institutional structures. It is a publicly traded corporation accountable to its own shareholders. It competes with other asset managers. It must attract and retain clients. Its revenues derive from management fees based on assets under management. If investors withdraw funds, its influence diminishes. This dependency underscores a fundamental point. BlackRock's size reflects the trust and capital allocated to it by millions of investors. In the end, the idea that a single company secretly governs the planet obscures the more nuanced truth. BlackRock is one of the most influential financial intermediaries in history because modern finance channels enormous amounts of capital through centralized managers. Its role highlights both the efficiencies and vulnerabilities of a globalized investment system. Rather than asking whether it rules the world, a more productive inquiry is how societies should regulate and oversee institutions that manage collective wealth. Power in the 21st century often manifests not through visible command, but through networks, incentives, and flows of capital. BlackRock sits at a strategic intersection of those flows. Its policies are debated. Its growth reflects structural shifts in how people save and invest. Yet, it remains part of a broader ecosystem of economic actors. The story of BlackRock is ultimately the story of modern capitalism's scale and complexity. It demonstrates how aggregated savings can translate into concentrated managerial influence. It reveals how financial institutions can shape corporate norms without holding political office. It challenges us to think critically about transparency, accountability, and the future of global markets. The world is not ruled from a single boardroom. It is shaped by interconnected institutions responding to incentives, regulations, and human decisions. BlackRock is one of the most powerful participants in that system, but it does not stand above it. Understanding that distinction allows for informed debate rather than sensational conclusions. In examining BlackRock, we confront larger questions about who controls capital, how markets distribute resources, and how democratic societies balance economic efficiency with public oversight. Those questions extend far beyond any one company. They define the ongoing conversation about the future of global finance itself.